Yeah, absolutely. And corporate banking's got a bit of a special place in my heart because I started my career in M&A, but then because I was at HSBC, one of the biggest balance sheets of any bank and one of the biggest corporate banks in the world, that was our sweet spot. So really excited to talk about corporate banking today. I think it's worth, again, taking that step back and thinking about the nuts and bolts of what a bank does. And obviously, if you are a bank in your most traditional form, you make money from the spread between what you give out on your deposits and what you charge on your loans. That is a bank. Now, the typical bank or a typical universal bank will serve individuals through retail banking, but they'll also serve companies. And the heartland of any relationship with a company is lending and taking in deposits and earning a spread. And that is where this is corporate banking. Now, corporate banking specifically is focusing more on the larger companies. So talking maybe 300 million revenue plus. So you're lending money and you're providing really, really significant and important types of debt, whether it's equipment finance, leasing, trade finance, real estate finance, but this is all balance sheet stuff. I always just as an aside, I always like to think of a bank a little bit like the sun. And the sun is your lending, your deposits and lending. And then all that orbits around the sun is all of your auxiliary and additional stuff. It's your products, it's your advisory, it's your M&A, it's your market making, it's your liquidity provision, etc. But the sun, for these major banks, the sun is your balance sheet and the sun is your lending.
I'm assuming then that, hey, let's just be transparent, like things like that and career progression, there's a clear track within that particular part of the bank as well. I mean, can you put it in context as to why people always want to work in the banking side and not corporate banking, for example, in context?
Yeah, it's really interesting. I reckon the pay per hour is probably just as good, if not better, than investment banking. And quite frankly, that's why I moved from investment banking to corporate banking. It has exactly the same career progression up from analyst through associate, VP, SVP, or MD into team lead. And the salaries are really, really good, but it is slightly less time bound, slightly less intense than maybe working in M&A. And there's a number of reasons for that. In part because quite a lot of the work that you are doing in the corporate bank is refinancing existing, maybe quite complex loan products, possibly bringing together lots of other banks in what we call a syndicated bank transaction. Again, this is not easy stuff. You might even be responsible for underwriting that syndicate. So there's some complexity there, but the urgency of we need to do this deal and we need to respond to this auction and we need to get our next bids in. Not all of your activity in a corporate bank is determined by that time pressure. Now, that said, some of the fun stuff is when you're doing an acquisition financing, right? So if I am buying a company for $2 billion, I might choose to finance that in part with a term loan provided by a number of banks. And then the deadlines get a little bit tighter. You are working really, really closely with your investment bank colleagues, your M&A advisors, maybe your equity capital markets team who are helping to do a raise in the private markets, whatever it might be. And that's why, you really do overlap quite nicely with the investment bank.
Yeah, I was about to ask kind of two questions there. You were starting to unpack some of these products of the corporate bank. You mentioned a few there, but then also any more things around how you work alongside the investment bank in itself?
Yeah, I'll take that. I'll take your second question first. A lot of people, and I think wrongly so, describe the lending part of a bank in the context of large corporates as a bit of a loss leader. So, hey, we'll lend you money in order to get the sweet high margin advisory deal. And it is a lot more likely, and I can tell you with some experience, it is a lot more likely that you will get an advisory fee on the M&A side if you are willing to put up a chunk of your balance sheet. So it's often used as a bit of a sweetener. And it was definitely used with the BNP, Paribas, HSBC, etc. Certainly got a lot of their advisory mandates by lending a lot of money. But notwithstanding that, you should be a profitable, highly significant revenue generator in and of yourself. And it's just an added bonus when you can get on the investment bank ticket and really get a very, very good payday. And remember, as I say a lot when I'm teaching, banking is all about trust, especially at that top level. And it might be that you've lent to a particular company, you've started with a smaller relationship and you've lent to a particular company for 5, 10, 15 years. And it's through that trusted lending relationship, the more quote unquote vanilla relationship, that you end up being first in line for an IPO or for a debt capital markets bond issuance or whatever it might be. So this is such an important element. And remember, not all financial advisory firms have that balance sheet, right? So you look at Jefferies, Jefferies is an elite boutique bank, but they advise us, right? They don't have the balance sheet power. Although they are expert at the world of advisory and investment banking, they don't have the heft of a balance sheet like an MUFG, like a Bank of America, like a BNP, like an HSBC to come alongside. So it's a very different flavor of bank. And it's a really, really interesting place to be.